Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 6, Capital Budgeting, Business Risk, and Capital Structure. In this topic, we're going to show how we can modify WACC for projects with different business risk and financial risk as the existing firm. We're going to account for differing financial risk by using project debt-to-equity ratios and tax rates to relever the beta and compute a new cost of debt. We'll also summarize when to use WACC or other discount rates such as KD. Lastly, we'll discuss how capital budgeting is conducted in the real world. So here's an example where the Apple Corporation, the tech firm, is going to do one more, or is looking at doing one more tech investment, say a new gadget, which is right in their existing business line. So what's going to happen in this project? It's going to last a finite amount of time. It's going to be a 3-year project that costs $1,500. We'll just make the number small to fit it on a screen. And we're going to forecast sales and EBITDA and free cash flows for the 3 years. And we're going to make another assumption, which is often done with finite life projects, in which the working capital is liquidated at the end of the 3rd year. We'll talk more about that. Now, the important thing to remember on this one is this is Apple choosing to do one more investment in their current business line, the current industry. So we think it has the same business risk. And they're going to use the exact same capital structure, DD ratio, as the existing firm. This gives them license to use their WACC to calculate the NPV of this project, or use the WACC as the hurdle rate for the IRR, because we think this project has the same risk as the existing firm, and we think the WACC reflects the current risk of the existing firm. So let's go to the model. So let's start off. We think the sales are going to be $2,000 in the first year. And then sales are going to grow at 10% the first year. And then they're going to grow at 5% the second year. So there are my sales. Now I have something here called an EBITDA margin. So it's the project's EBITDA percent of sales. So it's a quick way of getting the profit straight from the sales, that of the 2,000 sales, 60% will wind up as EBITDA. In other words, 1 minus that, 40% is really the cost of goods sold. So there's my EBITDA for the project. Well, make sure I anchor the EBITDA percent. And now depreciation. Let's assume that the CapEx of $1,500 is going to depreciate it over 3 years using a straight line. So I'll just take my CapEx, I'll anchor that, and I'll divide by 3, anchor that. So there's my, and let me make that a negative sign to show a subtraction in this case. So there's my CapEx per year, $500 a year for 3 years. Now I can take my EBITDA, include the depreciation, and now I have earnings before interest and tax, which is my EBITDA minus depreciation. I'll then take and that's my EBIT. I'll take that times 1 minus the tax rate, 40%. And now I have my earnings before interest but after tax, which also may be the net income. So here's a common problem with trying to do this analysis, is I'm ignoring debt. So if you're ignoring debt, we call this earnings before interest but after taxes. However, if this is a firm that has no debt, it would also be earnings before net earnings. Now I do have a DDE ratio that's not 0. So this isn't exactly the net income of the project. It's the net income of the project if the project had no debt. So we'll call it earnings before interest but after tax. So we also call those our unlevered profits. The net profits of the firm had no debt. Now we're also going to make the assumption that working capital as a percentage of sales is 10%. So in the first year, we're going to get some working capital, say receivables and inventory equal to 200. And then it's going to go to 220. And then I'm going to make a big assumption here. Since this is a finite life project, the project ends at the end of the 3rd year. And what you're going to do is you're going to make sure all the payables and receivables are paid off and then liquidate your inventory. So I'm going to say by the end of the 3rd year, working capital has to be 0. So I highlighted that in the assumptions. So the change in working capital is it's going to go up to 200 the first year, go to increase by 20, but in the third year, it's all going to be liquidated. So now I can calculate my free cash flows to the firm. I'll start with my earnings before interest but after tax. I'm going to subtract the changing working capital. And then I'll add back the depreciation because that is not a cash expense. All right, and since I'm starting with earnings, this earnings before interest and after tax, the depreciation tax yield is already included in the numbers above because I subtracted it before computing profit. However, I need to add back the non-cash expense of depreciation. I'll then subtract CapEx, which is $1,500 today. So these are my free cash flows to the firm. We'll assume no residual value at the end. And I also have a note here that one of the assumptions is there is no terminal value. It means the project completely ends at the end of the third year. So now I can calculate the NPV. However, to do that, I'm going to need a WACC. So the only thing I can calculate right now is an IRR. So I'll take the IRR of my investment, 38%. So now let's calculate the WACC. The DDE is 0.25, so I take my DDE over 1 plus the DDE, tells me the percent of debt divided by both debt and equity. So DDE plus, or divided by 1 plus the DDE. It's 20% financed with debt. If I take 1 minus that, 80% financed with equity. I'll calculate my CAPM cost of equity, risk-free rate, plus, and actually let's do a couple name ranges here just for fun. I'm going to give that a name of RF, that risk-free rate, so a named range. And I want to call this cell here the number, MRP. So I can now say that my CAPM cost of equity equals risk-free rate plus that beta times the MRP. So there's the expected return of the stock, or the required return on the stock is 14%. I then calculate the CAPM cost of equity times the equity percent plus the debt percent times a cost of debt was given here of 10%. And we're going to take the after-tax cost of debt, so I'll take out the tax rate. So we got a WACC of 12.4%. Looks like the IRR exceeds the WACC, which is my cost of capital. We'll consider that a hurdle rate. So it looks like we'll accept this project. Or the other way to look at it is if we take the NPV, where I take the WACC, the future cash flows, and subtract off the current cash flow, I get 791. So it looks like we're going to do this project. And again, since this project had the same leverage, DDE ratio, and the same business risk, tech risk, as the existing firm, we have the license to use the WACC because the WACC reflects the current risk of the firm. Now, what if the project is going to be financed differently than the existing firm? So the project is going to have a different DDE and, say, tax structure as the existing firm. In that case, what we're going to do is we're going to unlever Apple's beta by using Apple's current firm tax rate and DDE ratio. That'll give us the risk of the tech business if Apple had no debt. And then we'll re-lever it based on the project's DDE ratio and the project's tax rate. What that'll do is it'll get the business risk of tech, but the leverage or financial risk of the investment, and then we'll plug that into CAPM. So we can do that first. We'll go to the next area here, and then basically it's the same model, except we have some more assumptions. Now the project is going to have a DDE of 0.5 and a tax rate of 35%. So the first thing I did, I already did this for you, is I went ahead and I calculated what the unlevered beta for Apple is by taking the levered beta of Apple, the one which you calculated looking at their historical stock prices and running a regression, and dividing that by 1 plus Apple's after-tax DD ratio. So Apple would have currently has a levered beta of 1.5. If they had no debt, they'd have a beta of 1.3. That's an unlevered beta. And then I'm going to calculate what the beta would be with this new project. It would be the unlevered beta, which captures the business risk, times 1 plus the project's after-tax DD ratio. So this project would have a beta of 1.73, reflecting the higher leverage. All right, so now we're active. We've now calculated the new levered beta. All right, plugged it in. We're going to plug it into the CAPM formula. So where's my CAPM formula? Right here. Equals RF plus the new beta times MRP. So that would be my new cost of equity. Now the question is, what is the cost of debt? Well, if the new investment is going to have more debt than the firm, than Apple, the firm, you would expect that the cost of debt, when you go to borrow money from a bank or issue a bond to borrow money that way, you'd expect that investors will demand a higher return. And one way of thinking about that is all debt, all cost of debt, or KD, has to be equal to at least the risk-free rate for investors, plus some kind of extra credit spread, sometimes called, or credit premium. Now this credit spread, the extra you have to pay over treasuries, or the extra you receive from an investor standpoint over treasuries, is sometimes called a credit spread, the default spread, the debt spread, or the bond spread. All those mean the same thing. And what that means is the extra return or yield of that bond or loan over a same maturity treasury. So if treasuries are, say, 10%, or a 10-year treasury is 2%, and Apple can borrow at 10%, we say it has an 8% credit spread or default spread or debt spread or bond spread. Now this project's going to have more debt than the existing firm. So we're going to have to try to come up with some way to figure out what the spread would be. Now let's go back here. If I take Walmart's existing firm, the risk-free rate is 5%. We'll assume that's for all maturities, say 1 through 30. And the cost of debt in this project, or for the firm, is 10%. So 10 minus 5 is Apple's current credit spread or debt spread. I'm going to make assumption that this project with more debt, because of their higher DDE ratio, is going to have a credit spread of 7%. So if I just take the risk-free rate plus that new credit spread of 7, that would be a cost of debt of 12%. Now, how you can actually get that, you can go to the S&P or Fitch's or Moody's and try to get some data, either looking at, say, a DDE ratio, or right here I got some data from Demoderin looking at coverage ratios. And what you could actually do is you could forecast what the coverage ratio is or the DDE ratio is for your investment. And then you could look up that, well, the average firm that has this DDE or this coverage ratio would roughly be this bond rating. And then you could see that roughly that firms will say whatever this bond rating is. So, say you're forecasting the project's going to have an interest coverage ratio of 2 to 2.5. That would be equivalent to a double B rated firm. And double B rated firms have a credit spread or a default spread of about 2%. So that's another way you can think about how would I estimate that. So what is the debt spread or credit spread for firms with similar financial risk, maybe in your industry? So that allows me to calculate my cost of debt of 12%. And now I can actually just calculate my WACC. So if I just take my new debt percent, which is the new DDE, divided by 1 plus the DDE, that's my debt percent. If I take 1 minus that, it's my equity percent. And it looks like I have the formula here all set for WACC. Well, let's make sure we have it correct. The cost of debt, 7 plus 5. And everything looks good. So now I can actually, if I wanted to get in the tech business, Apple wants to get in the tech business, but use a different credit spread, use a different capital structure. It looks like a bad decision, to tell you the truth, because it's increasing their WACC. And notice that whenever you change a DDE ratio, since we're talking about unlevered cash flows, free cash flows of the firm, it never affects the cash flows. So the only thing it can do is it can affect your discount rate for your NPV or your hurdle rate. So now if I calculate the NPV of this project, and all I'm going to do is I'm going to switch the NPV formula to use a different discount rate. That's the NPV if Apple plans to use more debt. It looks like it was a bad decision. Now notice that the IRR is unchanged because the cash flows are unchanged, right? Because IRR is not dependent upon, or the calculation of IRR is not dependent upon the actual discount rate. Now that discount rate for 1285 is going to probably be my cost of capital, my hurdle rate, but the IRR is still 38%, but it did lower the NPV. All right, so that's how we handle the fact that Apple is in the same industry but wants to use a different capital structure. And basically it's going to, in this case, increase the WACC. Now it wasn't clear that the WACC would increase. Now remember, there's several moving parts if you increase the debt of a firm. If you increase the debt, the beta is going to increase, so cost of equity will go up. If you increase the debt of the firm, the debt spread or credit spread will also go up, so cost of debt will go up. So you'd think automatically the WACC has to go up, but that's not necessarily true, because generally the cost of debt is less than the cost of equity. So even though they're both increasing, you're increasing the weight on the lower rate, KD. So it could turn out that actually increasing debt increases value by lowering the WACC. Now let's look at a different example. What if this tech investment that Apple wants to do is a little bit different? What it wants to do is actually have an investment in the cable industry. And they think that actually the investment is more like the risk of cable than it is of technology. So in that case, we can't use Apple's beta, because Apple's beta reflects both Apple's financial risk and Apple's business risk, right? Because the stock has been moving based on the risk of the tech business. So what I could do is I can either find an unlevered beta for the cable industry, which we learned out how to do that before, and lever it up for the project's DDE and tax rate. The other way to do it is just find a very specific proxy or comp, we call them a comparable firm. Say the project we think is going to have the same risk as the risk faced by Comcast. So what I could do, here's Comcast information from Yahoo Finance. Comcast has a levered beta of 0.96. If I take their net debt and their market cap, I get a DDE ratio of 0.32. And if I look at Comcast, it looks like they had a 37% tax rate. So what I could do is I can take Comcast, instead of an industry, I can take Comcast beta of 0.96, unlever it, and figure out what the unlevered beta is for Comcast, and we think that'll capture the risk of the cable business. So I'll do that. So here's the data I collected: Comcast tax rate, DDE, and levered beta. I then can calculate, I'll make this a little bigger, I can then calculate the beta of Comcast if they had no debt by dividing by 1 plus Comcast after-tax DDE ratio. So Comcast would have a beta of 0.8 if they had no debt. So we can consider that capturing the business risk of cable. Now, Apple plans to have some debt. What it plans to have, we'll make the assumption it's going to have this capital structure. So what I can do is then relever the beta based on the projects or investments DDE ratio, 1 plus the DDE times 1 minus the tax rate for the project. And that's going to give me a beta of 106. I can then take the risk-free rate plus that beta times the market risk premium, and that'll be the cost of equity for that project, for that investment in cable. And then I can calculate the WACC, my cost of equity, times my weight of equity, we already calculated that here, plus I'll assume this is still my cost of debt of 12%, times my weight in debt times 1 minus the project's tax rate. So I get a 10.17 WACC for an investment in cable using that particular capital structure. So now I can calculate the NPV of cable by just copying this formula that has my, well, let me format that to turn it back to a percent. It's just added too many decimal places. So I can take my NPV formula and just flip my discount rate down to here. So it's going to use 1017. Looks like cable's safer than tech. And I get an NPV of 890 of this investment in the cable industry by using Comcast unlevered beta, but then using the project's DDE and cost of debt. So that's how we handle both different business risk and different capital structure. Now we're going to add a little bit to this model. Most of the models we assume are not finite models. Again, finite meaning this project ended in year 3. Let's model this as if it's an ongoing concern. It's going to go on forever. And how we do that is either through a free cash flow multiple or a growth perpetuity. So I can either just at some point realize cash flows are going to grow forever at some growth rate, or I can do a cash flow multiple. We're going to do a variation of this cash flow multiple we haven't done before. We're actually going to use an EBITDA multiple, which is actually more common. So let's go to our model. Notice here it used to say that the terminal value is 0. The project's died. Now it says the EBITDA multiple is 6.5. So when this project concludes, we think it's going to be worth 6.5 times EBITDA. So let's do the calculation, then we'll talk about that. So here's our model, same as before, except the yellow cells we need to change, or have changed, or we need to change. So the first thing we're going to assume is this is now an ongoing concern. So I'm no longer going to liquidate my working capital. It's just going to keep growing over time. So I changed that formula. Also, at the end of the project, it's no longer going to just die. I think it's going to be worth 6.5 times EBITDA. The EBITDA is 1386 I'm forecasting. So one way, this is probably the most common way, so investment banks and maybe venture capitalists and private equities might value an ongoing concern, is they know that a particular industry or subset of firms, you can actually observe that you can say, look at your 3 closest competitors to this firm. Look at their EBITDA, look at their enterprise value by looking at the total market cap and total value of debt. And you can actually calculate that on average, firms in this industry sell for about 6.5 times EBITDA. So this firm, in 3 years, we expect to have EBITDA of 1386. So I'll assume it's worth 6.5 times that. So you can think of, if I were to buy this firm, and then maybe you're thinking like a private equity firm, I'm going to buy it, and then I'm going to hold it for 3 years, get the EBITDA a little bit higher, and then I'm going to sell it, and I think I can get 6.5 times EBITDA for it. So I'm going to hold the firm for 3 years, collect the cash flows, and then sell it for $9,009. So these are the total cash flows from the purchase and then sale of this investment. And it's a way of thinking about the value of the ongoing concern. So now I can calculate the NPV of this by just not using the cash flows in this row, but the ones that include the multiple, the EBITDA multiple. And then I go to calculate an IRR. Now the IRR is going to be huge because we're going to get this huge cash flow in year 3 if we sell it. So I now have an IRR of 118%. And I have an NPV of 7,455. So this is a very, very common way to do valuations. Now the reason why they like to do EBITDA multiples and not free cash flow multiples, right? I could have said it's worth some number times this final free cash flow, but actually it's much easier to calculate EBITDA because every firm, you can just look in their income statement and get their EBITDA. You don't have to do calculations of adding depreciation shields and trying to deal with working capital. It's a lot easier to look at EBITDA. Also, for very young firms, they'll often have a positive EBITDA before they'd have a positive free cash flows because of all the CapEx. So what you're trying to do is it's just more stable to use EBITDA, which is a measure of kind of operating cash flows, sort of. right? It's just looking, it's really the gross profit. So, and you would think you can think of it as operating cash flows. So it's just more common to use an EBITDA multiple than a free cash flow multiple. But you could have done it the other way. You could have just said, well, in the end, I'm just going to use a 2% perpetual growth rate of my free cash flows. So the only difference here is in this formula here, I'm going to say this right here is my year 3 cash flow. I'm going to take the year 3 cash flow, and I'm going to increase it by 1 plus the growth rate forever. That is now the cash flow in year 4. I'll then divide that by my WACC minus my perpetual growth rate. So what I've done is so far the numerator is the value of the cash flow. Here, let me blow it up a little bit. The numerator in this equation right here is the value of the cash flow in year 4. I divide it by K minus G, which gives me the value of those cash flows in year 3, which is a nice place to place this because this is the cash flows in year 3. I add it to the cash flow received in free cash flows in year 3. So I can sum up the total value, which is the value of the cash flow in year 3 plus the present value of all cash flows from year 4 to infinity discounted back to 3. So that is the total value of cash flows in year 3. I can then calculate my NPV by simply taking the present value of that row. So this is a nice little trick that in previous examples, I'd put a year 4 out here, right? And I'd forecast free cash flows in year 4, then I'd always have to discount it back to 3. But by putting the growth perpetuity under year 3, but using the cash flows in year 4 as the numerator, it'll give me the value in year 3, and then I'll discount it back by using NPV or using my discounting function, just taking the cash flow over K minus, or 1 plus K to the 3. And then I can take the present value of all future cash flows. So that is valuing the cable business using an EBITDA multiple and using a constant growth perpetuity. Now here's an interesting finding after I did all this analysis. When I calculate the final model, right, I do the final model and look at growth rate, perpetual growth rates between -3 and 3% and WACCs between 8 and 12. You see that it's clearly always positive. So it almost requires no more analysis of WACC or growth. If these are truly my extreme ranges of WACC and growth, the project is obviously going to be accepted. Another way of thinking about it is look at the IRR of this project. The IRR is 138%. So one way of thinking about valuing an investment is don't worry about the WACC. Calculate the IRR first. If the IRR is so absurdly high compared to what a normal range for WACC would be, I don't even have to think about calculating the WACC because I know the WACC is nowhere near 138%. So maybe I'll just take a crude estimate of WACC and just call the project accepted. Now let's talk a minute about international capital budgeting. Since we're talking about all kinds of ranges of projects you might do, how would you deal if the project is international? Well, we're going to do 2 different things to it. The first thing you do is when you take a net present value of cash flows, they have to all be in the same currency. And since we're going to take the perspective of a US-based multinational, you got to convert all the US cash flows into dollars. How we're going to do that is we're going to get the spot exchange rate and forward exchange rates for any foreign currencies we have. Now the spot exchange rate would be the one if you just look on the internet or go to the airport and kind of get an idea of where the exchange rates were. A spot exchange rate is an exchange rate for immediate conversion of one currency to another. A forward exchange rate is an exchange rate usually published by a bank or published in some financial websites or on Bloomberg. And what they are, it's an average of exchange rates that banks are offering for future delivery. So you can go to a bank and say, hey, I expect to receive 100 million euros next year. What exchange rate would you guarantee me today for delivery of euros into dollars next year? And that would be called a forward exchange rate. And you can use the forward exchange rates as an unbiased predictor of future exchange rates. So we're going to use that to convert cash flows into dollars. And then the other thing you can think about, well, Foreign projects, especially if a foreign investment is in, say, a developing economy, you can a lot of times consider those economies riskier to operate. So there's two ways of dealing with that type of risk. The easiest way to do it is to just add something to a WACC or a discount rate. So a common practice is if I were going to launch a project in Indiana, all right, so say ExxonMobil wants to build a plant in Indiana, it will calculate the domestic WACC. If they want to operate that same or start that same project in India, what they do is they can take that domestic WACC and add something called a sovereign risk premium, which is simply the difference between long-term treasury rates and long-term sovereign or federal bonds, the rates on those federal bonds in the foreign country. And if, say, India has long-term sovereign yields, say 3 or 4% above U.S., we'll add 3 or 4% to the WACC, call that the sovereign risk premium, and that's how we'll capture the risks of operating in India. If you don't do it that way, the only other way to do it is maybe find a proxy firm that's foreign. Find say maybe for ExxonMobil, find a power company in India, get returns of their stocks, convert them to dollars, so get dollar returns of their stock, and then calculate beta and use as a proxy beta and delever it and relever it like we did in the other examples. But we're not going to do that. We're just going to use the easy way and use the sovereign risk premium. So I collected some data, so again, you're not responsible for this course. If you did a global finance class, you would. But I'd show you how you can look up the current spot price of, say, the yuan. This is the Chinese RMB. On this day, it's trading in the spot market at 6.77. And then if I knew how to decode this forward exchange rates, I could figure out that the 5-year expected exchange rate is 7.27. And I can do the same thing for the euro. The spot price of the euro is $1.09. If I can decode how to think about these bid and ask quotations, I could figure out that it looks like the market is expecting the euro to be trading for $1.11 in 1 year. But I'll just give you that for this course. And just a note, I'm just going to show you in all the examples of doing an MPV for a US-based firm, all we need to do is know how to convert a foreign currency into the US dollar. Now, there's always two different types of exchange rates. There's either direct exchange rates. Those are exchange rates in which the quoted exchange rate is in dollars. Now, in the U.S., there are only 4 exchange rates that are generally quoted in U.S. dollars, or we call them direct. The euro, the pound, the Australian dollar, and the New Zealand dollar. So these are approximately the values of those exchange rates. $1.10 for a euro, $1.22 for a pound, 75 cents for an Aussie dollar, and 71 cents for a New Zealand dollar. Now, if you have a direct quote, it's pretty easy to convert a foreign currency into a dollar by simply multiplying times the direct quote. So if I take 1,000 euros, multiply times the dollar per euro exchange rate, notice in cross multiplication, the euro cancels out and it gives me an answer in dollars. However, all the other currencies in the world for an American are generally quoted in indirect terms. In other words, the Chinese yuan is quoted as 6.8 RMB or yuan per dollar. The yen is quoted at about 105 yen per dollar. The Mexican peso is quoted about 19 pesos per dollar. So it's the foreign currency price of $1. If you have a foreign currency and you need to convert the foreign currency to dollars, you need to multiply 100 yuan times the dollar over yuan exchange rate. So the yuan cancels out and it gives you dollars. Now what that functionally means is you basically have to divide by the exchange rate. 1 over 6.8 is the dollar per yuan exchange rate. 6.8 is the yuan per dollar exchange rate. So in this case, I really just take 1,000 yuan and divide by 6.8. I take 1,000 yen and divide by 104. And I take 1,000 pesos and divide by 19. So that allows me to do this example, and we'll just talk about this briefly. Is the last example is, here's an example where I spend 9 million as a US-based firm. My CapEx is 9 million yuan. I'm going to convert that to US dollar by using the spot exchange rate, which I'll give you. And then they're going to generate revenue in yuan. I'll convert those to dollar by using the 1, 2, and 3 year forward exchange rates by dividing. I'm also in the region, so I'm going to sell a little bit to India and gain some rupee sales. I'll convert those to dollar by dividing, oh, here it is, by dividing by the 1 and 2, 3, and 1, 2, and 3 year rupee exchange rates. I then have some Chinese costs in yuan. I'll convert those to dollars. And say I'm using some technology and I have to pay some royalty to a French firm in euro. In that case, I have 10,000 euro expenses a year. I'll convert those by multiplying by the forward dollar per euro exchange rates. And then lastly, I'll manage this out of the States and have some SG&A expenses, selling and general administrative expenses. I'll leave those in dollars. So that gives me an EBITDA of summing all that up in dollars. And now I can just do the regular NPV formula that I've done for every other one. I can then calculate taxes, get earnings after tax, or earnings that's earnings after tax before interest. I can then add back depreciation, subtract CapEx, take care of any working capital, in this case is negative, and calculate an NPV and IRR. Now in this case, since this project is in China, I could, for my NPV and my IRR hurdle rate, take the domestic WACC, which say 7% would be the WACC if this project were in America. And I'll add the difference between long-term treasury rates and long-term Chinese rates for their sovereign debt, their federal debt. So I would take my domestic WACC plus the sovereign risk premium for China. I'll use 8%, and I'd calculate the NPV of that project. So that's how I'd handle a foreign project. So let's summarize a couple of things. One is, how do I think about what discount rate to use for NPV or what hurdle rate? Well, if the project has no or close to no business risk, in other words, it's like an infrastructure project. I'm thinking about buying a new copier and that's not part of my business. Or I'm thinking about converting from a traditional heat to solar heat, but that's not part of my business model. I'm not in that business. You could justify using a risk-free rate as your hurdle rate, but many firms will just use the after-tax cost of debt for nearly risk-free investments. If the investment has the same risk as the current firm, in other words, it's in the same industry, using the same capital structure, I would just use the existing WACC, using the firm or industry beta. If it's in the same industry, but different capital structure, I'll just relever the firm or industry's beta using the project's DDE tax rate and add the new debt spread. If the investment has a different business risk, say outside their industry, so this is Apple we're operating in the cable business, I'll adjust the WACC by relevering a proxy or industry beta, so that my proxy beta was Comcast, or I could have used an industry beta for cable, and then relever it based on the project's DDE tax rate and get a new debt spread. And if it's international, I could do the same as above. I could maybe find a proxy of a firm that operates overseas, or you can just use the same cash flows, convert them to US dollar, and use a sovereign risk premium to your domestic WACC. All right, so this is how you can think about what discount rate you should use for an investment. Now, in practice, firms often do not change their capital structure for a different project, right? They don't want to change everything, so you might look at an investment, but just generally firms may hold the capital structure constant. Also, firms often will not recalculate a WACC using any of these methods for every single project. What they might do is, in every single time, what they might do is they might have a rough idea of what their after-tax cost of debt is. It's roughly about 5 to 5.25%, say. So they might just use 5% for every project that appears to be pretty low risk. And then every project that appears to have roughly the same risk as your industry, they'll probably use the WACC. Maybe they'll just round it. So, say our WACC we think is between, say, 8 and 11. We just might use 10% for every project what we consider to be kind of average risk. And then some firms might just say, anything it's above the average risk that we think we're facing in our industry, we might just have another WACC that says like double your firm WACC or 1.5 times your firm WACC. So what I'm saying is firms don't always calculate a bottoms-up WACC for every investment. they might just categorize it as very low risk, average risk, and a high risk investment, and do some initial analysis of what those WACs might look like, or discount rates, and use them. Lastly, capital budgeting in practice. As a financial manager, you're in charge of the capital budgeting process, which means selecting which investments. In theory, you should always accept all positive NPV projects. However, in practice, there's always capital rationing. So you may have $1 million of capital, but a $10 million of requests for capital and NPVs, and all of them are positive, but you can't do them all. Also, in practice, at least when I was in capital budgeting, some projects just have to be accepted regardless of their NPV. So this might be projects you just have to do. So it's almost like when I was working at IBM and Freddie Mac, we're looking about the Y2K conversion, worrying about the calendar date switching over and messing up computers. We never had to calculate an NPV. We just know we had to do it. And also I just noticed or knew that there's some projects that influential managers in the corporation, they thought as pet projects, and they thought they're important to do no matter what the NPV was. And lastly, I hate to say this, but people lie. As a financial manager, people are requesting funds to expand their business areas. And often their careers, their jobs are tied to getting those capital requests. So that you have to realize that people have incentives to make assumptions that make their projects look good. And we can call them lies, but in the end, if you have a decision, maybe to make a decision on working capital and a decision on maybe lower working capital increases your NPV, you might make that assumption. Lastly, as a non-finance manager, say you're working supply chain or marketing or HR, and you just want to get your project accepted, you truly believe it's important, and the NPV demigods come back to you and say, no, the NPV is not high enough, or the IRR is not high enough. Test their assumptions. Are the cash flows too low? Are their assumptions on revenues too low? Are their costs too high? Is their CapEx assumption too high? So you can test that. Are they using the most aggressive accelerated depreciation increase working capital? You can also look at it and you could argue for a lower discount rate. What if your project is in HR, maybe isn't affected by the actual business risk of technology? You can make an argument that their WAC, their discount rate for the project should be treasury rates, or at least the after-tax cost of debt. You can argue that your investment has longer-term positive prospects, which means that you think the growth perpetuity must be higher, or your EBITDA multiple must be higher. And lastly, you could argue that, that my project, the NPV is not a great way of measuring the value of my project. So say you have a little project that it doesn't cost a lot of money, but it has an NPV. But if it's successful, we can then expand in that area. If it's not successful, we'll close it down. So what we say is NPVs do a terrible job of dealing with investments that create real options to maybe expand in that area. So what that means is you might have a negative NPV to do a little project in another country. And if it's successful, then we can expand full force into that project. So that's not the normal NPV isn't capturing the value of that future business. So in this topic, we talked about how we modified WAC for projects with different business risk and financial risk. We summarized when to use WAC or other discount rates such as cost of debt, and we discussed how capital budgeting is performed in the real world.